I have said that last week we were discussing about, or we were supposed to discuss advanced financial decision, but I felt ill, and I shared a video of weighted average cost of capital. And this video shared with you covers the WMCC, which is basically the combined cost of the existing funds, which are normally or which are being used to undertake the firm's existing projects. And in that case, when you are calculating the WMCC, and if you can be able to look on the knowledge which you garnered when you are doing the intermediate level, you can be able to share with me, or you can be able to agree with me. We said that it is a combined cost which is normally made up of component costs, and that is the component cost which we are discussing is the cost of equity, which is normally denoted by KE, cost of preference shares, that is KP, and the cost of the long-term debt, which is KD. Now, when you look on the cost of equity, under the section 3, intermediate level, we were discussing about the cost of capital, and it is a topic which expounded more of the component cost being one of the characteristics of it. And in that regard, we said whether you are doing the WMCC or WMCC, it means that you have to be using the component costs. And these component costs, they have different formulas as denoted in our first video. So when you will be able to check on the first video, you'll be able to see the interpretation of the cost of component costs, and where we have been able to do some few questions regarding to it. But today I just wanted to look at the weighted marginal cost of capital, which we are saying is the combined cost of raising additional new funds to be used by the firms for undertaking the new projects. And you'll be able to see this different from whatever we have been discussing under the WMCC. The WMCC, we normally need to check on the existing capital structure of the organization. But here, we are trying to look on the new funds, which we can be able to utilize them by undertaking the new projects of the organization. When you look on the differences which are existing between the WMCC and WMCC, we are saying the WMCC is the cost of the existing fund being used to undertake the existing projects, which we are discussing about the historical costs. But under the WMCC, it is the cost of the additional new funds for undertaking the firm's new projects. And that is what we normally discuss about the futuristic costs. But when you look on the side of the WMCC, another difference, we are saying the market value weights are basically used. But on the WMCC, we are saying that the marginal weights are used. That is, the weights are determined, right? The weights are basically determined from the optimal capital structure. Esther is saying there is no sound. And I think you can be able to hear me. You can't hear me? Am I audible? Moiro?
It was a bit shaky at first. Now it's clear.
Just 1 minute. So let us proceed. We are saying that under the WMCC, the new fund shall be raised from each of the capital component based on its proportion in the optimal capital structure, so that even after undertaking the new project, the firm's capital structure does not change. So at times there may be more than one source of finance from a given capital component. And that one challenge, you know very well, it normally comes with the aspect of equity, which normally comprises the ordinary share capital and retained earnings. And in such a case, the firm shall fully utilize the amount available from a cheaper source, right? Before any additional funds can be raised from a more expensive source. That concept, you shall be able to understand it when we are doing an illustration. So when you look on the aspect of a breakpoint, which you normally use when you're doing the WMCC, we say, it normally refers to the level of financing at which the amount available from a cheaper source from a given capital component is fully utilized. So I would like us to do an illustration here, because a lot of illustrations will not be help us to get or to understand more about what we have to be knowing. So let us start with September 2021, question number 4B. September 2021, we can be able to check on that. So September, I think it should be in August somewhere. Let me see. August 2021, right? So September is there. Question number 4B. So someone read the question, please. Someone read the question.
Dinosoft Limited capital structure, which it considers optimal, is given as follows. Hapo chini imepeana additional information. The firm's history earning per share EPS and dividend per share DPS over the last 5 years are as follows. 2016 EPS 6.5, DPS 3. 2017 6.8, DPS 3.10. 2018 7.0, DPS 3.30. 2019 7.5, DPS 3.50. 2028 DPS 3.60. The company ordinary shares currently sells at shillings 50 per share at the security exchange. At the security exchange, new ordinary shares will be sold at this price. The company's expected net income for the year ending 31st December 2020 is 40,000. Dimosoft Limited adopts a constant payout ratio of 40% as its dividend policy. The company can raise additional capital as follows to finance acceptable investment projects. Equity capital, utilize all available retained earnings for the year ended 31st December 2020. Any extra additional equity will be raised through issue of new ordinary shares at a flotation cost of 10% at the issue price. Preference share capital. New preference share capital will be issued at 11% coupon rate at par value of each share at shillings 100. New preference shares will be issued at par subject to a flotation of shillings 5 per share. Debenture. New debenture can be sold at coupon rate of 13%. The debentures will be issued at par. Corporation tax is 30%. Required, calculate the breaking point in the marginal cost of capital schedule. 2, the weighted marginal cost of capital in each interval between the breakpoint. 3, Dimosoft Limited has the following potential investment opportunities. Required, using the investment opportunities schedule, advice on which project to accept and hence determine the firm's optimal capital budget.
Thank you so much. When I look at that question, you could be able to see an examiner is giving you some areas where you are supposed to be raising additional capital. But in that case, you can be able to see some securities which you're going to be issuing there, or which you can be able to utilize to raise the additional funds. Now, when that is said and done, it is very important for you first to look on the capital structure of the organization. And when I look on the capital structure here, I can be able to determine or say that this organization is basically financed by debentures, equity, and some of the preferential capital. We know some reserves and some of the money which is normally kept by the CBK for the corporates. We know that that is one of the acts for the corporates which they are supposed to comply with. This money is basically used for any emergencies or when the company is facing some financial constraints. So in that case, it means some of your reserves are part of your equity. So when you are doing this question, and I can be able to see in the first question of the examiner is asking us, where the question please is asking, can we be able to calculate the breakpoint in the marginal cost of the capital schedule? That is very simple. It means when you are discussing about a breakpoint, right? In most cases, an examiner is not going to be giving you this kind of a question. But if, for example, because I have to be giving you a broader explanation about how you're supposed to be computing these, when these questions comes in an exam, for instance, you just want, you have first to start by looking on the weights. Those are the existing capital structures which we are using. So in this case, you start by having the source, right? We normally pick your sources, right? We have the source, we have the amount, then we have our weights, right? So in this case, when I look on the current capital structure of the organization, it comprises of debentures. The amount for debentures I can see is 25. Let me use thousands. So 25,000. Then we have some equity there. The equity comprises 25 for ordinary shares. Is it 25 or 45? And 15 for reserves. Right? These totals to around, I think it should be 60,000. Then we have preference share capital. Preference share capital. Our preference share capital amounts to 15,000. These totals to 100,000, right? So what are some of the weights? So in this case, when you look on the weight, it means I take 25 divided by the total, getting 0.25. This is 0.60. Then this is 0.15. They are supposed to equate to 1. Correct. Now, I could be able to see the examiner is asking you about the breakpoint, right? The examiner is asking you about the breakpoint. But do you know, under the breakpoints, it relates to retained earnings, and the examiner has not given you the retained earnings, correct? So in this case, it means if you want to compute the retained earnings, if you want to calculate your retained earnings, it means we are going to be looking on the net income. For example, I could be able to see in the question an examiner saying that in note number 3, the examiner is saying the company's expected net income for the year ending at December 2020 will be 40 million, right? And then we are being told Dinosoft Limited adopts a constant payout ratio of 40%. If you are going to be paying 40% to the preference shareholders, how much are you going to be retaining? It means you're going to be retaining 60% of 40,000. 60% of 40,000 translates to 24,000. Right? Translate 24,000. Now, an examiner is asking you about the breakpoint. The breakpoint, it means if you are going to be utilizing this source of finance without giving anything. For example, when I come to the weight of equity here, I can see it is similar to our retention ratio, right? But in other instances, it might not be. So in this case, when you see I'm saying, if 60% is equal, that 60% is not this for the retention ratio. No, it means we are dealing with the weight for the equity. If 60% is equivalent to 24,000, you ask yourself, what about 100%? If there is no any money you are going to be giving out, right? How much will be your, how much will be the breakpoint for the retained earning? It means you're going to be taking 100 over 60 times 24,000, which will be taking you back to your net income of 40,000. So an examiner was asking you, if, for example, you are not going to be giving out anything, right? How much can you be able to retain? How much can you be able to retain? So in that instance, it means you're going to be retaining everything. You're going to be retaining everything that the company was able to generate in terms of the profit after tax. Now, in note number 2, right? I know that one is well elaborated. Number 2, an examiner is asking you to compute the WMCC, sorry. And we have said, when you are calculating the WMCC, you have to be understanding very well that regardless whether you're doing the WMCC or WCC, you have to calculate something we are calling it component cost. we have to be doing the component cost, right? And our component cost, I'm going to be starting with the cost of equity. And under the cost of equity, I just need to write my formulas as per denoted in the first video which we did. So in this case, we are going to be taking the current dividends if they are the ones that we have been given. We divide it by the market value, which is our PO plus G here, right? Now we said under the cost of equity, we normally have two cases, yeah, right? We said equity normally comprises of retained earnings and ordinary share capital. And we said we are going to be calculating the cost of equity of the two to see the one which is cheaper, right? Which one is cheaper between the two. So in this case, we have to be looking on the elements which are affecting both, which normally assist you to differentiate the retained earning and the ordinary share capital. So in this case, it means the ordinary share capitals are normally affected. The market value is normally affected by the discounted flotation when you are dealing with the ordinary share capital, right? When you are dealing with the ordinary share capital. But when you are dealing with the cost of equity of the retained earnings, it means you take your current dividends, right? You divide it by the market value minus the discount plus the growth rate. It means that the cost of equity for the retained earnings are not affected by the flotation. The flotation is a cost incurred by the companies for issuing shares to the public for some. That one you know, but we are not going to be issuing the retained earnings, right? So that is why we are saying the market value for the retained earnings is not affected by the flotation cost. Let us go back to the question and we look whether we can be able to get both. So let me start by calculating the cost of equity of the ordinary share capital, right? The cost of equity of the ordinary share capital. I think number 3 is already done. We are already done with it. Now, when you look on in that note number 1, 2, and 3, we can be able to see, being told in note number 2, the company's ordinary shares currently sells at 50 per share and the securities exit, but the new ordinary shares will be sold at this price. Now, we have already been given there the market value, right? Our PO now we are being given is 50. But there is one thing that I have realized, that the examiner was not able to give you the growth rate. And we say, if you are calculating the growth rate, you can just be able to take n minus 1, right? We take the root of, we talk about the most current dividends. The most current dividend you divide by the most past dividends. Then all of these you multiply by what? We subtract 1, sorry. We subtract 1 there. Now, in this case, when you look at it, you might not be able to identify the most current, but examiner has given you the earning per share, and then we also have the dividends per share. Now, in this case, the current year which I can be able to see there, and we have to be looking on the dividend per share. These are the dividends which we are issuing. So the most current dividends of yours should be how much? The most current dividends should be, for example, the number of years, which is our n, is 5 minus 1. The root of what? The most current dividends is 3.60. You divide this by the most part should be the first year, which is 3. Then all of these, once you get all of these, you subtract 1. So when you break it down, it will be 4, right? The root of what? When you take 3.6, you divide by that, I think you should be getting something closer to 1.20, right? And then all of these, you subtract 1. How can I be able to do this? You normally take your calculator, right? You press 4 in your keyboard, then shift, and then there is like a button looking like this in your calculator. So it will be 4, x and root. It will be looking something like that. So in this case, it will be, when I look at it, I will just be able to take 4, I press it in the keyboard, shift, then I press this button. There is a button which has this sign in your calculator, right? So shift that button, and then I put 1.20, right? Getting 1 point, you're getting something closer to 1.047 minus 1, getting 4.7%. That is your growth rate. Then, if that is the growth rate, let me see whether this question requires you to do both the cost of equity for both. And we can be able to see note number 4. Note number 4, we are being told on the side of the equity that the utility, utilize all the available retained earnings for the year that far December 2020. That is what we have done in the aspect of the breakpoint. And we are saying any extra external equity will be raised through the issue of new ordinary shares at a flotation cost of 10% on the issue price. So in this case, it means when I'm getting the cost of equity of the ordinary share capital, it will be we are saying the current dividends, which is 3.60, 1 plus 0.047. We divide it by what will be the market. The market price we are being told is 50 minus a flotation of how much? The flotation we are being told it is 10%. 10% of 50 is how much? 10% of your market price, which is 50, which will be 5, plus your growth rate of 0.047. So how much it is? So 1.047 times 3.6, you divide this by, you divide by 45, because this is around 45, you divide by 45, right? Then you add 0.047, you get 13.08. Now, if you want to calculate the cost of equity of the retained earnings, it means the retained earnings of ours is not going to be affected by the flotation cost as we have earlier discussed. So it will be 3.60, 1 plus 0.047. You divide this by 50 plus 0.047. So how much is this? So 1.047 times 3.60, right? Divide by 50 plus 0.047, getting around 12.24. If you compare both proportions between the ordinary share capital and the retained earnings, you can see the cost of equity of the retained earnings are the cheaper because of the comparison of the cost of equity or the proportions which you have already computed there. Now, once we finish with that, that is the equity, we go to the cost of preference shares, and we say the cost of preference shares, we normally take the preference dividends, you divide by the market value, it might be affected by discount and flotation, then you multiply by 100%. Now, how much is the preference dividends? We go to additional number 4, but on the side of the preference share capital, where we are being told, the new preference shares will be issued at 11% coupon rate. So how much is the coupon rate? We are going to be checking up there, but we are being told in here, so the par value of each share is 100. So the new preference shares will be issued at par, subject to a flotation of 5. Subject to a flotation of how much? Of 5. So in this case, it is very simple. We say the preference dividends we are going to be issuing at 11% of par, which is 100. Then the market value. When you look at it, we don't have a new changes in the. We are still issuing our preference share capital. The market value we are issuing at par, which is 100 minus 5. All of these we multiply by 100%. How much are you getting here? So 11 divided by 95, we are getting 11.58. 11.58. Then at the last one, which is the cost of debt. You normally have to be checking whether your debts are redeemable or irredeemable. It means if, for example, you find the new debentures are being issued at par, then it means that the coupon rate becomes the pre-tax cost of debt. So in this case, it means rather than taking an interest, because we could have taken the interest divided by the market value and then we adjust for tax. So we are, when I look on that statement for debentures, we're being told the new debentures can be sold at a coupon rate of 13%. The debentures will be issued at par. It means they are going to be issued at original price. So in this case, it means, in simple terms, you just need to take 13%. Then you adjust for tax of 0.3. So how much is this? So 0.13 multiplied by 0.7. Getting around 9.1%. 9.1%. 9.1%. That is how you normally use when you are computing. Someone could have told me you are not able to see the whole of it. Okay. you can be able to see everything now. Okay. And that is okay. So that is how you normally compute it. That is how you normally compute your component cost. Your component cost. Once you get your component cost now, it's easy for you. Someone is greeting us, is saying, Mwalimu, I'm not understanding. That is Roslyn. You can just be able to pinpoint the area which you are not understanding so that I can be able to repeat. You can unmute and ask the question. And if you are not understanding this concept, it means you have not watched the first video for WMCC. Just open the mic and you speak, Rosaline. Hello? I wanted you to open a mic, you tell me where the areas you're not understanding. But now, what you need to be understanding, what I want to put clear, and I have been able to see the way you are watching these videos. Most of you, even they have not watched the portfolio theory and analysis computation. They have not watched. I saw a very minimal number. The other numbers are coming from the Facebook, but the access from you guys, very minimal. You have not been able to concentrate and being able to put some hard work in the videos which I've already been sharing with you. And this is what you're going to be finding in an exam. So from last week, when I've been sick, I was able to share the WCC, and I have not seen even a single student ask me a question about the computation of the WCC, because what we are doing here, we are just continuing from where we left in terms of the video which I shared. I could not be able to repeat the same concept which I shared with you a week ago, right? So that is why I've said, and when, for example, if you are there when I was starting the class, I was able to introduce to you the concepts from the WMCC, and I said, we are just going to be differentiated between the WMCC and WMCC. WMCC, we want to raise additional funds, right? This is different from the WCC, where we normally just want to look on the existing capital structure of the organization. Now, in this regard, we say, if you are looking on the breakpoints, and it's very crucial for us to make an understanding, the breakpoint of ours, we are going to be breaking points to make, the breakpoint, it means you have to be looking for more money. Rather than putting some money in the, for example, let me put an, when you are getting your salary, rather than paying the rent, we say, this month, the salary which I'm going to be getting from the X Limited, I'm not going to be using it, right? I'm not going to be paying my rent. I'm not going to be paying my electricity. I will be able to look on the other sources. That amount I'm going to be utilizing to finance a certain project. That is the concept of the breakpoint. And that is what we have done here. Then I have said, whether you are using the WCC or WMCC, the component costs are must. You have to be computing it. And I say, this concept of the separation of the retained earnings and the ordinary share capital always happens under the cost when you are doing the WMCC. This concept is not applicable when you are doing the WCC. Now, that is what we discussed about. And I say, if you were able to look on that first video for WCC, you could be able to see how I was able to raise some, or I was able to give you different methods in the computation of the growth rate. And you can be able to adjust the method to use, because they are always true, right? The method for the computation of the growth rate. This applies based on the values which were given in a question. So in this case, it means that we were given the DPSs. The DPS which you are already given, right? Those are the dividends which we have already paid, like the one that your circle has already given you. I know now you are very rich because the dividends are already be declared, and when the market was able to pay their dividends and so on. So in this case, if the dividends you are able to receive them, then we say, can we be able to use this formula in the computation of the growth rate? Because when you look on the formula, the growth rate has to be given by the examiner. If it is not given, it's very important for you to look for it. That is what you have done here. Once you finish, I said, now we have to be looking on the cheaper source between our two branches of equity. That is the ordinary share capital and the retained earnings. We said the ordinary share capital is normally affected by the discounted flotation, but the retained earnings are never affected by the flotation because they are not issued to the public for subscription. So that being said and done, right? that being put in consideration, it means now that when you're doing your computations here, you have to be factoring the flotation. If the flotation was not given, sorry for the net. I see there is a challenge for my network. Sorry for that. So I'm saying that if, for example, you find we have, I was here to explain about the ordinary and the retained earnings. And I said, we have to be looking on the cheaper source, which you can be able to utilize when you are raising additional funds. Now, once you finish by computing their proportions, you can be able to continue with the next component, cost, and I was able to go to the cost of preference dividends, cost of preference share capital, and that is what we have done here. And I said, for example, for the aspect whereby it can be able to happen whether you are doing the preference or you are doing for the debt. So when you find that the security is being issued at par, right? There is no any proportion which has already changed when you are issuing these security to the public subscription, then it means the coupon rate becomes the cost of preference share, if it was the case, or it becomes the cost of the debt, or the cost of the debentures. You can be able to see here. When you read the last illustration, the last aspect of note number 4, right? Note number 4, you could be able to see an examiner telling you that the debenture will be issued at par, that we are not going to be changing the proportion for the debenture. We are still going to be using the par rate, which is 13%. That is the coupon rate. So that is why I said, if any security is being issued at a coupon rate, then it means, for example, in our case here, the rate becomes the pre-tax cost of debt. That is what I said. Then you adjust for the taxes, and then you are able to get the cost of debt in that manner. Think now you can be able to understand. But before you attend any class, it is very important for you to remember to take your previous video very keenly. But I was able to realize you're not watching the video. You're not being able to do so.
Mwalimu Siraba hapo chini, mimi sijaona.
Sawa,
Hapo kwa
nafika tu hapo, pole. Now, allow me to calculate the WMCC now. So when you are calculating the WMCC, in this case, we are saying, let us take the weight of equity, cost of equity, plus weight of preference, cost of preference, plus weight of debt, cost of debt, right? Now, you remember very well, there are some of because zangu nimefuta hapa to press some space, you could be able to identify that there are some of the weights which we had already calculated here. So the first one, for example, the weight of equity was 0.6, right? Let me just wrap that, because there is something which we have to be looking at. When you are looking on the breakpoints of viewers, right? The breakpoints, the WMCCs are normally calculated as per your breakpoints. So in this case, it means we need to be starting with the minimum. Remember, we want to raise how much, right? Examiner did not tell us how much we have to raise, but what we are very sure of, we have 40 million. You can just be able to come in and say, can we be able to calculate the WMCC of raising up to 40 million? Can we be able to calculate the WMCC of raising up to 40 million? Where are we taking the 40 million? Because it's the cheaper source here. You can see it in the minimum even, in the minimum rates, under the ordinary share capital and the retained earnings. So when you are calculating the WMCC, we normally want to look at where can we be able to raise money and using the cheaper source. So in this case, we say the weight of equity is 0.60. Then we multiply by the cost of equity. The cost of equity for the retained earnings, because the maximum retained earnings can be able to give us is 40 million. You say we multiply by 12.24. We add the weight of preference. When you look at it, the weight of the preference was 0.15. We multiply by the cost of the preference was 11.58. Plus what? When you look on the last one, right? The last one, the weight of debt. The weight of debt, you were able to get around 0.25. We multiply by the cost of debt, which is 9.1. So how much is this? What is the WMCC of raising up to 40 million? What is the WMCC of raising up to 40 million? Very simple. Very simple. Someone to tell me what is the WMCC of raising up to 40 million? Someone tell me what is the WMCC of raising up to that? Nobody with a calculator? Nobody. Let me take mine. We say 0.60, we multiply by 12.24 plus 0.15, we multiply by 11.58 plus 0.25 times 9.1. We are getting something closer to 11.36%. Now, this is what the maximum, the retained earnings can be able to give you. The retained earnings, the maximum amount they can be able to raise is 40 million. But what if we need more than 40 million? What will be able to happen? You say, can we be able to calculate the WMCC of raising above 40 million, right? If, for example, we need more than 40 million, what will be our WMCC? And we say, if we want more than 40 million, we have already exhausted the retained earnings because the maximum retained earnings can be able to give you is 40 million. Above that, we can be able to use the expensive source, which is the ordinary share capital. So in this case, it means if you want to get this WMCC, you take 0.60, you multiply it with the 13.08. But the others remain the same. 0.15, you multiply by 11.58 plus 0.25, you multiply by 9.1. So how much is this? How much is this? So 0.60, you multiply by 13.08 plus 0.15, you multiply by 11.58 plus 0.25, you multiply by 9.1, getting something closer to 11.86%. 11.86%. Any question? Any question? Any question? Now I know I can be able to rub here, right? Okay. Silence means things are good. Let me just rub here.
Alafu mwalimu, adjust camera tuone huku chini.
You're not seeing here?
Yeah, like hapo kwa yeah, I cannot personally. Yeah, thank you.
Check.
Thank you.
You're most welcome. Let me check. I think now you should be able to see. See. Should be okay now. Can you be able to see now?
Yes.
Okay. Good. Okay. Now, in this case, there is a requirement number 3, which discusses about investment opportunity schedule. Number 3, investment opportunity schedule, right? What does this talks about? And we say it is a graph. It is a graph that compares. It is a graph that compares the internal rate of return, right? Normally compare the internal rate of return and WMCC for investment decisions. For investment decisions. So we normally say the projects whose IRR is above, WMCC are normally accepted, and vice versa. are normally accepted and vice versa. So the first step, let me put this point. The first step is to run the projects. The first step is to run the projects using internal rate of return. Using the internal rate of return, and we say the higher the better the project. The higher the better. The higher the better. Let me just put it in that manner. The higher the better. Now, when you look at our project there, and I know very well you can be able to see how the questions are being tested there as per the requirement given there. Let me just go back to the question. We are being told, we are being given some initially there. We have some internal rate of return, and then we have respective projects as given, which are already given down there. So in this case, when the questions looks like that, what are you supposed to do to draw your graph? Very simple. Just be able to show the simplest way which you can be able to use. The simplest way which you can be able to use to get that question, right? All right. So this is the simplest way. So you have your projects here. Yeah? I can just be able to take my projects. I take my internal rate initially. I can just be able to accumulate my initial rate, by the way. Then we have our IRR at the end. I think you can be able to see up to that point. Now, in this case, allow me to take those shillings to millions. So here we are going to be having 10. We have projects, by the way. We have V, W, X, Y, and Z, right? So we have 10, 20, 10. 10, 20, 10, we have 20, 10. So when you're accumulating here, you have 10, we have 30. Kuna mtu ajui accumulation, by the way? No. This is what we find for simulation. This plus this, we get 40, 60. Then we have around 70 here, right? You have around 70. Then you can be able to take your IRR. The first one I can be able to see is 16, 14. We have 11, right? You have 10 and 8. 10 and 8. Now, in this case, I just want you to draw your, we are drawing our graph, right? Between IRR and the cumulative initial play. So the first one will be, and you know my amount here are in millions of shillings, by the way. My amounts are in millions of shillings. Then here is where we are going to be drawing our IRR. Then we compare with MCC, correct? Now, in that regard, you can just be able to come up with the N, because you can see here your cumulative internal initially. By the way, you can just be able to put the way they are. So let me just put them the way they are. The first one I just say is 10, 20, we have 30, 40, 50, we have 60, and I think the big one is 70. Then we have the highest here being 16. So you can just talk about 2. Mine might not be accurate. 4, 6, 8, 10, 12, 14, and 16, right? So when you're drawing, you just need to take 16 against 10. So 16 against 10, you can be able to see it somewhere here, right? 16 against 10. But mine, yours should be accurate. The other one will be 14, 14 against 30, right? 14 against that. Let me just draw my lines here. So 14 against that will be somewhere there. Then the other one will be 1140. Then you look at 11 is somewhere here. So 1140 should be somewhere here. I think it should be somewhere there. Then the other one will be 1060. So 10 is here. Then you go to 60. So when I look at 10, just check here. 1060, which is somewhere there. So 1060, right? 1060 should be looking like that. Then the last one now. The last one should be 870. When you look at 80s, yeah? We have 870. I'm not good in drawing, but I'm trying. So it should be looking like that. This is how your graph should be looking like, by the way. And I know I have not drawn the first one. Then, once you draw it in that manner, unakuja hapo una name your project. So the first box represents B, W, X, Y, and Z. These are your IRR you have already drawn against the required of the initial clip, right? But you are saying we have to be comparing with the WMCC, the ones that we were able to get. Remember, the WMCC, we talked about the WMCC of raising up to 40 million, right? That WMCC was 11.36. 11.36, right? So 11.36 should be lying to where? So 11.36, remember this is 11. So 11.36, I can just be able to draw it somewhere here on a straight line. Remember, it changes when we reach at 40. Usishangae na drawing yangu. So remember, it is the WMCC is breaking at 40. We say at 40, it increases because here we have already utilized the retained earnings. And once they are already exhausted, it means if we need an additional funds, then we have to be checking on we have to be looking on the expensive source, which we said it is the ordinary share capital. That is the difference between these proportions, by the way. The ordinary share capital, this is cheaper, this is expensive. So in this case, it means if we need to raise more than 40, right, which is the rate is 11.86, something very small here. Something very small, eh? So it is something that looks like that, right? Don't judge my drawing. So in this case, it means between 0 to 40, the WMCC of ours is 11.36. And then between above 40, we were able to get 11.86%. Now, when you have those problems now, you come back. Once you draw up to that point, you come back here. We say, what is our IOS? We say it is a graph that will be able to compare the internal rate of return and the marginal cost of capital of investment decisions. So the project whose IRR is above WMCC. When you look at it, we have only two projects whose IRR is above the WMCC. And we have said those projects are going to be exempted. But those projects whose internal rate of return are below our WMCC are going to be rejected. So in this case, to make your decision, we say, we look only for the projects whose the IRR is above and you advise. We advise you and you say, right, project V&W, project V and W will be accepted. Project B and W will be accepted. And then you look on what will be the optimal, we say, and the optimal capital budget, the optimal capital budget for the two projects is Kenya shillings. How much do we require for the two projects? I can be able to see this project, the initially required in the combination of two, which you can be able to get as 30 million. 30 million. That is the amount required to undertake the accepted projects is 30 million. 30 million, right? And remember, we were raising 40 million. So in that case, it means we have a surplus, right? We have a surplus there. Unless there is someone who has a question, I can be able to answer. Someone with a question, please. Someone with a question? Just as a question. Don't just keep quiet, right? Just as a question, please. Moiro, is it okay? Moiro, is it okay?
Yeah.
What about Esther? What of Esther? It seems we don't have Esther in class. Fanis? Fanis? No answer. Okay, it means that we have already understood. Let me just do this because tomorrow I just want us to do capital structure theories. I just want us to do similar question regarding to with the same setups. Then I'll not be able to give you an assignment today because I have not been able to see any assignment shared with us, which is unfortunate. We just need to be able to see. We have only 1 month. And once I do 2 questions for WMCC, unataka nirudi hapa nikuja kufanya nini? Sitarudi hapa kwa WMCC because already I've done the questions which are already tactically tested there. So it means that I will not be able to get back here, right? For WMCC will not be able to come back. When you go to the capital structure theories, I'll just be able to do the questions which they have tested there, right? Maybe for the current period. And it means that once we do them, do you expect me just to come back there? No. It means that these Modigliani and Miller propositions, we are going to be understanding them more as I do in class, right? Then that is why I need the full house here. Then when we get to the special topics in advance, topics in financing, you normally come up with a topic which they like to test regarding to the adjusted present value, right? Amada models, which discusses about the gear and geared beta and so on and so forth. So just allow me to finish up with the WMCC. Then once we finish this area, then we can be able to concentrate on other matters, which I think we should be completing next week, God willing. Now, Fanny, thank you. So let us go back to the questions and we look for someone to read our question right now, because now we are moving very quickly. So when I'm coming back here, we are looking for 2016. Is it 2016, 2017? Question 1B, which should be May 2017. May 2017. Where's my May now? Let me check. It is here. Right. Someone will be able to read our question. Question number 1B regarding to Kenzel. Kindly. Fanis. There is someone who doesn't want to read. Esther?
Okay, so Kenzel Limited has the following capital structure, which it considers optimal under both the present and forecasted conditions. Source of capital, long-term debt, 45%, equity capital, 55%. The total is 100%. The management of Kenzel Limited forecasts the after-tax earnings for the forthcoming year at 2.5 million. The company has been paying 60% of its earnings as dividend, and this payment ratio is expected to continue into the foreseeable future. The company's present loan commitment will allow it to incur additional leverage according to the schedule presented below. That is the schedule. The company's corporate tax rate is 30%. The current market price of the equity shares of the company is shillings 22. The last dividend on equity shares was paid at 2.2 per share, and the expected growth rate is 5%. New equity shares can be sold at a flotation cost of 10% of the issue price. Kenzel Limited has the following investment opportunities for the coming year. There is that. So required, one, the amount in shillings at which breaks in the marginal cost of capital in the marginal cost of capital schedule occur, the weighted marginal cost of capital in each of the intervals between the breaks in the MCC schedule. 3, the internal rate of return for project A and C. And 4, using the investment opportunity schedule, advice on which project should be accepted.
Thank you so much. Just give me 5 or not 5. Give me just 2 minutes. 2 minutes.
Okay.
So we can be able to see the question is already there. And this question automatically gives us a leeway of how, for example, the first question was all about. We were testing the same things. So in that case, we are just going to be following up the same process. And I wish you'd be able to follow the process for the computation of the WMCC for better understanding. We just do this question again. Right. Now, thank you. So the question was tested on, so this is our question here. The question was tested on November, should be May, sorry. May 2017, question 1B. The question 1B, let me see, it should be 1B. So, where am I going to be starting my question, right? Where are you going to be starting the question? Now, number one, I would like you to check on the organization's capital structure is already given there. So, let me look on the source. We have our amount. Then we talk about our weights. Correct. So, the source I can be able to see, we have debt. Debt up there is giving us 45%. So let me just use the weights, 0.45. Then we have equity, which has 0.55. That is what we have already been given up there. But we are being told the management of Kenzel Limited forecasts the after-tax earnings to be 2.5 million, right? We have been told that the company has been paying 60% of its earnings as dividends, and this payment ratio is expected to continue in the foreseeable future. So you can just be able to ask yourself, how much is your retained earnings? So you'll be able to find your retained earnings will be 40, because if 60 you are paying out, 40% is going to be retained. So it will be 40% of how much? I can see how much was the profit after tax, which is 2.5 million. Let me just use 2,500. So how much is this? So in that case, you just need to say 0.4 times 2,500, giving it 1,000. Correct? That is 1,000 there. Then, being 1,000, you ask yourself, right? Can we be able to break point this, right? What would be the break point for this? And you can be able to say, because we have been told there, that the company's present loan commitment will allow it to incur additional leverage according to the schedules provided there, right? You can see they have already given you something there. But is it very important for us to look on the break point? Because we have been told the amount in shilling at which the breaks in the marginal cost of capital schedule occur. So let me start with the break points. Break points of a retained earnings, right? Then I was able to say, by the way, I said, you just come and you equate with the proportion for your equity. I said, if
55% is giving you 1 million or 1,000. You ask yourself, what if I don't give them money? How much would be the total retained earning when it is fully utilized? So it will be 100 divided by 55 times 1,000. How much it is? So 100 divided by 55 times 1,000 should be 18.182. Let me just put it like that because it's in thousands of shillings. That is one. That is the maximum amount we can be able to get from the retained earnings if it is fully utilized. That is how much you can be able to get, 18.182. Then I can also be able to see there where we are being given some breakpoints regarding to the loan amount there. So in that case, I can see we have a loan, incremental loan debt of 9%. So in this case, when you look on the number 2 here, the breakpoint of 9% debt. The breakpoint of 9% debt. You can be able to attest that if 9% debt is giving you 500, this 500,000, right? What if you utilize it fully? You just say, and you come equate with the proportion for the debt. You say, if 45% is giving you 500, which is this now, what about 100%? How much is it? So you just say 100 over 45 times 500. What is the maximum can this security give you, right? Times 500, giving you 111,111.111, right? Something closer to that. Now, we also have another component there. We have 11% debt. Number 3, 11% debt, which is giving us, currently, it is giving us 900,000, the maximum. So you come and you take your proportion for the debt. You say, if 45% is giving me 900, what about 100%? So it will be 100 divided by 45 times 900. So it will be 100 divided by 45 times 900. We are getting 2 million. In our case, it is 2,000 there. There's 2,000, right? That is how you normally calculate the breakpoint. Don't ask me about above 900,000. You don't have the maximum in that, right? That one, now there is not a breakpoint you can be able to get there. But when you look on these ones, we have taken the maximum values to give you, if you utilize them fully, how much will be the requirements or how much will be the values. Now, from there, that is the requirement number 1. Number 2, that is
Excuse me,
yes, yes.
I was late to come in, but can you kindly explain what you mean by the breakpoint of retained earnings? Like, why are we looking for the breakpoint of the retained earnings or the debt?
Now, remember, when you are dealing with the WMCC, you are looking for the additional funds. You are raising additional funds to finance your new projects, right?
Mm-hmm.
And the amount that we are getting, for example, the retained earnings, the total retained earnings of ours, because we are giving out 60%, the 40% is what we are retaining, which is equivalent to 1 million. But we are asking ourselves, because we want to finance new projects, which sources can we be able to utilize? Which sources can we be able to use to give us the maximum values, which we can be able to use to finance our projects? And that is why we are saying, rather than giving these people money, rather than giving them money, if you utilize these retained earnings and fail to utilize this 100%, how much can this source of funds give you to finance your new project? That is what it means by the breakpoint. The breakpoints are basically used to help you in raising of more funds, which you can be able to use to finance your new projects. That is the aspect of the breakpoints. So that is where you are seeing we are using the proportions for the equity for every source. For example, for the equity, which is 55%, we are asking ourselves, if 55% of our equity is giving us 1,000, which represents the retained earnings, what if we utilize that source fully to 100%? How much money can we be able to raise through the retained earnings? Tunapata, we can be able to raise 1.82 million Kenya shillings, right? Now, what about the aspects of the debt? We have been told we can be able to have an incremental debt. We have 9%, we have 11%. 9%, the maximum without being fully utilized, they can only give you 500. What if you utilize it fully? They can just be able to give you 1.1 million. If nataka hiyo loan, tuchukue loan fully. Tuchukue makompyuta, ukuje pale wafanye stationery zote. How much can your assets in terms of collateral ukipeana vizuri? Kwa hiyo 9%, inaweza kupea 1.1 million. Then tuko na 11% debt, which is giving us 900 at the higher level. But if, for example, we can be able to utilize it fully without looking on any other avenues of funds, it can give you 2 million. That is the aspect we are looking at. I think that is well elaborated. Because how?
Yeah, thank you. Yeah.
Okay. So number 2, we are looking on the computation for WMCC. And we said, if you want to calculate the WMCC, start with the component cost. Right? So in this case, we said, can you start with the cost of equity of the retained earning? We say, you can just be able to take DO, 1 plus D, you divide by PO minus D, right, which is the discount, plus the growth rate. But if you are doing the cost of equity of ordinary share capital, we say, you take your DO, 1 plus D, you divide by PO minus D minus F plus D. You know these are discounts. If it is available in a question, it normally reduces your market values. This is the flotation cost. If it applies in the question, it normally reduces the market value. These are the dividends which have already been issued. Then an examiner can be able to give you expected dividends. So if they are giving you the expected, you just need to take D1, right? D1 over PO minus D minus F, for example, plus your growth rate. These are the expected dividends or next year's dividends, the term with the examiner want to use. Now, that being said, let me just get back to the question up there. And we have been told the company's corporate rate is already provided, but we have been told the current market price of the equity shares is at 22 shillings. And we have been told that the dividends of equity share was paid 2.2 per share. Those are already paid. So those are the dividends which have already been paid. So in this case, if I'm calculating the cost of equity of the retained earnings, it means I'm going to be taking 2.2, right? 1 plus. Let me continue with that statement. We have been told, and the expected growth rate will be 0.05. You divide it by the market value, or the market value we are being given is 22. Do we have discounts? I have not seen it. Plus 0.05. Right. So do we have discounts? The new shares can be sold at a flotation cost of 10 of the issue price. So we don't have that. So in this case, I just need to take 2.2. We multiply by 1.05, getting 2.31. You divide by 22 plus 0.05, getting 15.5%, right? This should be 15.5%. Then when you calculate the cost of equity of the ordinary share capital, it means you take 2.2, 1 plus 0.05, you divide it by 22, minus, we are being told it's 10% of the issue price. We are issuing at the market value of 22. So in this case, it means that is the flotation cost. This is the flotation cost we are deducting here, plus 0.05. So how much it is? So it will be 22 minus 2.2, getting 19.8. So 2.2 times 1.05 divided by 19.8 plus 0.05, getting 16.67%. So you can see the retained earnings are cheaper compared to the ordinary share capital after you compute the cost of equity for each. Now, let us go to the debts, and you can be able to see, can we be able to calculate the cost of debt of 9%? And remember the proportions which we are being already given here, they are not going to be changing because they are already called the interest rate on incremental debts. So these are we normally talk about pre-tax debt, cost of debt. So it will be just 9%. You adjust for taxes, right? So this will be 9 times 0.7, getting 6.3%. The other one will be KD of 11%, which will be 11%. Then you adjust for taxes, right? I think you should be getting 0.11, sorry, 11 times 0.7. We should be getting 7.7%. Then you have KD KD of how much? KD of 13%. We should be 13%. Then you adjust for taxes. Getting how much? 13 times 0.7. Getting 9.1%. 9.1%. So just put a bit of sense here. Now, remember, we are going now to be calculating the breakpoints, including all these costs which we have already calculated in terms of the breakpoints. So in this case, right? In this case, let me start by looking on the cheaper, by the way. This one is not included. Remember the breakpoints of yours, we started at 0.1, which is 1.18. So we are going to be starting with the breakpoint. This is the minimum. When you compare between the three breakpoints, this one is the minimum. So you say, can we be able to calculate the WMCC of raising up to, right? It should be 111.111, right? What will be this WMCC? Remember, in terms of the debt, we are just going to be using the cheaper debt. Which is the cheaper debt, right? We shall be able to check on it. So in this case, the WMCC of raising all these, we are going to be saying, we are going to be taking the weight of equity, because the WMCC of ours now, the formula will be the weight of equity, cost of equity plus weight of debt, cost of debt. We don't have the preference here. So what will be the weight of equity? 0.55. We multiply by the cost of equity, which is one is cheaper. This one is cheaper, 15.5. Why are we using 15.5? Because 15.5 is giving us a higher value, more than 1.1, which is 1.8, right? Now, plus the weight of debt, which is 0.45, we multiply it with the cost of debt. Which one are we using, right? The cost of debt which we are using, you can just be able to see the 9%. The 9% is giving you up to 1.1, so which is 6.3. So how much it is? Just say 0.55 times 15.5 plus 0.45 multiplied by 6.3, we are getting 11.36%. Right? That is the WMCC. And you can be able to see the 9%, which you are able to get at 6.3, is just raising to 1.1. It cannot raise above that. The maximum it can be able to raise is 1.1. Now, let us look at the WMCC of raising. We talk about above this 111 up to. What is the next value, right? Above this one, up to 1.82, 18.182. What will be the WMCC for raising this? And in this case, which is the simple terms, we say, now, we are still using the same, or on the side of the equity, we are still using 15.5 because the retained earnings is raising up to 1.82 million. This is the maximum it can raise. So still we are using on the side of equity, 0.55 times 15.5 plus 0.45 times. Now we are not using 6.3. The reason being, 6.3 can only raise 1.1. Above that, it cannot raise. So which one is the next cheaper source of financing? We can talk about 7.7. Right? Remember 7.7 is raising 2 million, which is within the range for 1.82. So 0.55, you multiply by 15.5 plus 0.45, you multiply by 7.7, getting 11.99%. 11.99%. 11.99%. I know this one you can be able to know where it is coming from. 11.99%. Now, what will be the next breakpoint? And when you look at it, the next breakpoint now will be, the next breakpoint of yours will be now 2 million. Above 1.8, which I've just rubbed here, up to 2 million. Now, in this case, we say, can you be able to get the WMCC for that? The WMCC of raising above 118, we are calling it 18.182 up to 2 million. Let me just put it like that. So above it means the source, which is our retained earnings, cannot be able to raise more than 1.82. So we are going to be looking on the expensive source. So the weight of equity is 0.55. But now we cannot be able to use 15.55 because it has reached the limits. The maximum limit is 1.82. So above it, we use the expensive source, which is 16.67 plus 0.45. We multiply it with what? We multiply by now. When you look at 7.7, is raising 2 million, right? Which is the cost of debt for 11%. So still it is within the range. So how much it is? 0.55, we multiply by 16.67 plus 0.45, we multiply by 7.7, getting 12.63%. 12.63%. Now let us look at the WMCC of raising above 2 million. If we need more than 2 million, where are we going to be getting that money? You say, let us take the expensive sources, 16.67 plus 0.45. We multiply by the cost of debt, which is above the 2 million. Now we can be able to use that 10%, which is 9.1%. 9.1%, right? So how much it is? So 0.55 we multiply by 16.67 plus 0.45 we multiply by 0.5 multiplied by 9.1. We are getting 13.26%. 13.26%. 13.26%. That is how you normally compute your breakpoints. That is how you normally compute your breakpoints. And I know very well, if you're going to be repeating the same concept, you'll be able to understand how it goes. Now, once you finish that, because I know you have understood, unless there is any question, I know someone now might be asking again, why are you getting these breakpoints? Now, right? Now, there is a question which an examiner is putting down here. Is asking us, the examiner is asking, the internal rate of return for project A and C. And when you look on the area of the internal rate of return that's provided by the examiner there, it is not there. You see, it is not there, right? So how am I going to be getting it? And I can be able to see the project slide. The project slide is going to be determining whether we are using the annual net cash flows, which we are already given there. Are we using the annuities or lump sums? So in this case, for example, let me start with the project A. So project A, this is what I mean, Moiro. We are saying in project A, how do we normally calculate our NPV, right? How do we normally calculate our NPV? We say, we normally take the cash inflows, we multiply by the present value interest factor annuities, like our case are the annuities because of the project slide. Then we subtract our initial place, right? So in this case, when you look on the annual net cash flows, we have 155.41. We multiply by the present value interest PFFA R%, which the examiner is asking, but the number of years we have 8 years. Correct. Minus our initial outlay is how much? 675,000, right? And then because we want to get the unknown, we equate to 0. So take this on the other side, and we are going to be having 15,504, 155.41, present value interest factor annuity R%, 8 years, will be equal to 675,000. You divide here by 155.41. You divide here by 155.41. So the present value interest factor annuity, R%, 8 years. How much are we getting here? So how much it is? We just need to take 675,000. We divide it by 155.41, getting 4.3436. Ushapata hii answer, unaenda unaangalia from the table. From the table of annuity. From the table of the annuity. Unaangalia hii figure inalai wapi in terms of the rates, right? So let us check on that. I know now you have checked, you have mastered the figure Now, we are talking about, these are the tables. Now, when you look on the period, we are discussing about a period of 8, but you have to be looking at, we have gotten our answer is 4.3436. 4.3436. You just take 8 and then you go row-wise. I don't know whether you can be able to see. Let me just, yes. So 8 is here, the period of years. So you go row-wise. Up to you see 4.3436. And the rate which is here is 16%. 4.3436, right? Okay. So what we have seen from the table is equivalent to 16%. 16%. If you can be able to go and you look on the point of the annuity, you just take 8%, you go row-wise. Uangalie hii figure kama utaipata mahali. Ile rate iko pale juu ndio unasoma. Ours was 16%. Let us look at the project C. Project C there. What is under the project C, what is our cash inflow? Is 161,524. We multiply by the present value plus factor annuity. What is the rate? The rate which is being provided, we don't have, but the number of years is 3 years. Minus our initial outlay. Our initial outlay is 375,000. This should be equal to 0, right? So when you take it on the other side, you are going to be having 161,524. Present value plus factor annuity, R% 3 years. We should be equal to 375,000. You divide here by 161,524. You divide here by 161,524. So how much are you getting here? So 375,000 divided by 161,524, getting something closer to 2.3216. Hii unaenda unaangalia kwa table. What will be your rates? So narudi tu kwa ile table ya annuity. Narudi pale kwa table ya annuity. So when I get back here, naangalia now we are dealing with 3 years, but naenda nitafute 2.3216. Naenda row-wise. 2.3216 ndio hii, which is 14%. Nimesema nimeenda miaka 3, nikaenda row-wise, nikakuja hapa nikafuata 14%. So in that case nikapata the rate which is there is 14%. 14%. That is how you normally calculate when the internal rate of returns are not provided. When the internal rates of returns are not provided. And you are going to be coming across that kind of a problem in your exams. Those ones you might be coming across, right? Those problems might be there. Now, the last thing is very simple, and which the examiner has asked you to do is to draw the IOS. Now, in this case, if I want to draw my IOS, we said, just take your project, right? Initial list. You accumulate them. Your initial list, then you write your internal rate of returns there. So your projects, we are running A to E. So initial place of these projects, the first one is 675. We have 900, right? The other one is 375. D, we have 562.5. Then E, we have 750. Accumulate them, 675, 1575. So 1575, we add 375, getting 1950, plus 562.5, getting 2512.5 plus 750, getting that 262. Now, the internal rate of return of ours, the first one, for A, we have gotten 16%. Examiner kwa mepeana. The second one now should be 15. The third one, tukapata 14%. The other one, tukapata ngapi? The other one is 12 and 11. So mimi nakuja hapa nachukua to the table the way it is. Nakaa namna hiyo. So because of the hardship of the scale, mi naziweka tu venye ziko. So for example, the first one is 675. The other one will be 1575. This one will be 1950. 25, 12.5. Then the last one will be 32, 62.5. Then here we can talk about, we have, this one can come up with a good scale. We can talk about 2, 4, 6, 8, 10, 12, 14, and 16. Correct. So in this case, you can be able to start with the first one, 16, which is here, 16,675. So I can just be able to draw it just like that. That is my first project. Then 15, we're talking about 1575, something looking like this. Right? That one. Then the other one we have 14, which is there, against 19, you see there? So it is somewhere there. Right? Then the other one will be 12. 12 is there against this one. That is somewhere there. Correct. Then the last one will be 11, which is somewhere here. So 11 is there, right? So 11 is there. So 11 against that 262.5. So that is how you draw it. Now we are going to be looking at where we are going to be drawing now our WMCCs, right? Our WMCCs, and you remember the first one which you were able to get. The breakpoints, the WMCC of raising up to 1.1 was 11.36, which is somewhere here, and it was able to break at 1.1. So let me just say it is somewhere here, right? And then I say here is where 1.11 lies, right? That is where it lies. That is as per my estimates, correct? Then from there, the WMCC of raising the other one up to 1818, it is 11.99, right? 11.99. I was not able to write the projects of mine, so we have A, B, C, D, and E. Sorry. So the other one was able to go up to the WMCC of raising up to 1.88. Was coming to 11.99. So allow me just to raise it a bit here, something closer to that. Then 1.88, I just say it is somewhere here. 1.82, let me put it like that. It's somewhere there. Then we have another WMCC of raising above 1.8 up to 2 million. That was around 12.65. Right? So in this case, we are now going to up to 2 million. Right? So let me just put it somewhere here. So if it is 12.65, it's somewhere here. 12 point something there. It's going up to 2 million. This is 1950. So let me just say my 2 million is somewhere there. 2 million. When you are drawing it on your graph paper, it should be looking better. Then we have the WMCC of raising above 2 million, right? Which you are able to get around 13.28. 13.28. So this is 12, 13 is somewhere. So let me just put it like this. Mine is just elaborating, and this is your WMCC. So the last one we have said is 13.28%. Now followed by 12.65. Now here was 11.99, right? Then the first one was around 11.36. eh? So ukiambiwa uchague zile projects zinakuwa accepted, we said the projects whose IRR is above WMCC are going to be accepted. So in this case, when you're making your decision, you just say project A, B, and C, A, B, and C should be accepted. The project A, B, and C should be accepted, right? Then when you look on the optimal capital budget of the three, optimal capital budget, ile capital inahitajika to carry out the three projects should be around Kenya shillings 1950. Should be 1950. Should be 1950. And that is how you normally do the questions of WMCC. You need just to go back and do a bit of research regarding to that. Then you'll be able to find it is not something that is hard. It's not something that is hard. It's something that you can be able to manage and understand. Any question? Any question? Any question? Any question now?